Thank you all for being here tonight. Now it gives me great pleasure to introduce Clifford Asness, MBA 91, PhD 94. Cliff has had a long history with the University of Chicago. As a teaching assistant for finance professor Eugene Fama, Cliff came up with his own idea for testing the efficiency of markets. While trading mortgage-backed securities at Goldman Sachs, Cliff was asked to set up a quantitative research desk using this new research from university finance departments. With John Liu, AB 89, MBA 94, and PhD 95, and Robert Crail, two colleagues he knew from the University of Chicago, he built a computer model that identified the cheapest value stocks based on up-to-the-minute data, but selected only those that seemed to have started on an upward swing. Goldman used it to launch an internal hedge fund in 1998. Cliff wound up managing $7 billion in 2 years. In 1997, he left Goldman to found AQR, Applied Quantitative Research, Capital Management, with Lou Crail and David Biller, another Goldman colleague. The hedge fund they launched has grown from $1 billion to a diversified investment management firm of $30 billion, earning Cliff the 2007 Distinguished Young Alumni Award. Please join me in welcoming Cliff.
I'll start out a little confused. I'm the guy introducing the guy, and a guy introduces me. This ends in anarchy. Let me start right in. My favorite story, to keep the theme going, my favorite story about John Cochrane is in actuality, of course, a story about myself. John Cochrane is the AQR professor of finance. We're quite proud of that. It's not just myself. John Liu, who's been mentioned a few times, and I did this together. But I got sent, in one day, maybe 20 different people sent me a snapshot of a picture. Apparently, and John might be able to tell you the story more accurately, but John got so tired of being asked if he could get a student a job at AQR that he altered the sign with his title on it to John Cochrane, the I can't get you a job at AQR professor of finance. I don't know if there are any current students in the room, but please, if you know any, communicate to them. This is not true. John can get anyone hired who he wants at AQR, and you should just sign up for office hours anytime and spend some time with John, and it'll go smoothly. So let me talk about John for a moment. I'm told while introducing someone that is generally considered polite. John is an incredibly accomplished Chicago Booth professor, and that's an incredibly accomplished group of people to begin with. I'm biased here, but I think he's one of the greats. Just to read a few things, and his vitae is too long. He's the author of one of the Bibles, one of the things we read, an excellent book on asset management. He's an author of way too many great journal articles across way too large a variety of topics. Probably started out more in the macro world and has become macro and finance over time, and has been great at all of it. When it comes to being involved in the industry and in the academic kind of elite, he is currently the president of the American Finance Association. He's a fellow of the Econometric Society, and he is an adjunct fellow. This is my favorite one. I picked my favorites of a bunch of the Cato Institute, and I will admit I list that one partly because I lean that way myself, so that one pleases me to a great deal. On that front, if there was a Nobel Prize for academically crushing another human being, John would get it for his recent article, Why Did Paul Krugman Get It So Wrong? Apparently some of you, I'm sure, are sitting on your hands mad at me, but I'm speaking amongst friends more than I'm not, so that's good. John has won numerous awards for his research, but the one that stood out for me the most was he's also won awards for his teaching. And if you know John, you don't question his brilliance in his field, but he's also shockingly good at explaining things in a patient and clear manner. I'm someone who will send out emails on anything that is bothering me that day, and John has the misfortune to be on what I call my rant list. And I think I get it right more than I get wrong. I'm related to this field too. But I get it wrong sometimes, and particularly when I venture too far into the world of macro. And John will go, no, Cliff, the Keynesians are wrong, but not for why you say they're wrong. And it will be very, very helpful to me. Finally, on maybe a lighter personal note, if you've read his bio, he's a very accomplished glider. pilot, which John has convinced me is quite a green hobby if one is able to ignore the plane towing the glider. So, I'm sure I'm technically wrong on that, and he'll explain why it's really very efficient. Let me finish with how John became particularly the AQR professor of finance. When you decide, which is a big decision, to endow a professorship, it's quite clear you don't get to decide who it is. You make a commitment to it, and then the school chooses it. But I like to think this is what we call, and most of you are familiar with this concept, a multi-period game, not a single-period game. So it's probably not in the school's incentive. If you know me at all, and I've alluded to my leanings, it's probably not in the school's best interest to choose a professor of Marxist social theory to be the AQR professor of finance. And they certainly did not make that multi-period era in this case. So ideology aside, just by accomplishments, we're very proud. But in all respects, we're very, very proud to have endowed a chair that John sits in. And with no further delay, I'll give you John Cochrane.
Well, thank you, Cliff, for saying far too many nice things. Thank you, everybody, for coming out on a meteorologically unpropitious night. And especially, it's been wonderful to connect again with so many old friends and students that I haven't seen in too long. What I want to do tonight, I want to do an academic research talk. I think this is the Chicago Society, and Paul Sereno comes with his latest dinosaur, and I think the right tone is to do something similar. Because fundamentally, that's what I do, that's what we do. You may have seen a certain amount of blogging and op-eds and media and so forth, but that's a hobby. That's not what we really do, despite how much the business school webpage likes to celebrate it anytime we're quoted. We do research, and that's what we do with your money. Which is why I think it's right to show you some research. So I'm going to talk about a research topic that is really what I have been doing my whole career. I wrote my PhD thesis on this topic, and I've been thinking about it ever since. I started thinking about it my first year in graduate school, and that is the deep fundamentals of where does inflation or deflation come from. But I don't want to just do theory. Well, this is an interesting topic because it also applies to a lot of policy questions, so we'll talk about that too. Right now, the questions on our minds, if you read the paper or talk to the Fed, interest rates are zero, quantitative easing seems helpless. Are we going to be in a deflationary spiral or be like Japan? Or maybe, on the other hand, they've printed up trillions of dollars worth of money. Debt seems to be spiraling out of control. Maybe we'll be heading for inflation. Which one is it going to be? Well, this is a great moment to be a research economist and to think through deep theories. We are outside of historical experience. So just sort of the standard whatever worked last time is not going to work. You got to think. And I think we are headed for a moment, we're already in a moment, of fundamental change in our monetary arrangements. The euro is rethinking how it's going to run. You got to think. You have to. Theory, in some sense, summarizes a wider and wider historical experience than you have just in what's happened in the last 10 years. So thinking is good. I guess that's the Chicago mantra. So I'll talk about inflation, deflation, and money. Of course, in macroeconomic events, there's the mess of the financial and banking system and too big to fail and quote, reform, unquote, efforts. There's stimulus and unemployment and all that stuff. But we don't have all night, so we'll be talking about inflation and deflation. So let me start here with a little theory. I'm going to take you back to school, that warm, fuzzy feeling, A-level of the Regenstein. Don't you miss it. Let me remind you how we think of the value of a stock. You'll see why this gets around to inflation, deflation in a minute. We think of the value of the stock with the first equation there. Yep, you're going to get equations tonight, although I got rid of the Greek letters. You think of, there's the number of shares, there's the price per share, and that's the expected discounted stream of future dividends. If investors know that there's going to be good dividends in the future, then they bid up the price of the stock. And also, if investors, if they discount things at a higher rate, that is going to mean stock prices go down. And what drives stock prices is expectations way out into the future, not just what's happening now. So that's a reminder. Now, our job was not to do finance. Our job is to do macro and think about what causes inflation. And I think where I want to start is, well, what determines the real value of government debt? Government debt, the government's promised to pay you back, so the value of government debt has got to be the value of what they're promising to pay you back, and that's the second equation. We have government debt on the left-hand side. On the right-hand side is the expected present value of the surpluses, yes, I said surpluses, that they will run in order to pay back that debt. And the price level is what determines the difference between those two. So if we wake up, say tomorrow, and decide that our government is not going to be able to pay back its debts, what do we do? Well, all of us try to get rid of our government bonds before everyone else figures that out. Now, if we collectively try to get rid of government bonds, we got to buy other stuff. And if we try to buy other stuff, all of us, that sends prices up. That's the mechanism. So the value of government debt affects the price level exactly the way stock prices work. Nominal government debt is like stock in the government, and the price level is like the value of that stock. It works the same way. Now, that's nothing really unusual. I mean, this is kind of a new equation, but the mechanism I described, if you had been trained at MIT or Harvard, you would say, oh, I know that. That's aggregate demand. Everybody's trying to buy stuff. Yeah, exactly. That is aggregate demand. That's what it actually means. Is this something deep and new? No, not really. At a deep level, inflation, the price level at a deep level, what makes money valuable? This is the deep philosophical question of economics. Here, I have some just to, here's a business card that isn't very valuable, except to me. But, here's some money. It's a piece of paper. Yet, I can go out and get even in New York, a pretty good drink for $20. Why? But this is just a piece of paper. Why is that piece of paper valuable? That's the deep puzzle of macro. Well, there's an answer to that, and the answer really that this equation is providing is that money's valuable because the government takes it for taxes. I can give it to the bartender, and he'll give me a drink because he can give it to the government for taxes. And that's not a new idea. Adam Smith said, and I quote, "A prince who should enact that a certain proportion of his taxes be paid in paper money might therefore give a certain value to this paper money." So you see, there's nothing new here. But there is something new. Economics is not about dusty quotes from famous sages. As Feynman, the physicist, said, until you know where to put the e's in the two pies, you don't know nothing. And there's something really right about that. So there's more to do than just quote Adam Smith. It's also not new. So this view of inflation is there really in the footnotes of every other model. And I thought I'd bring up another Chicago one to contrast it with. So Milton Friedman's license plates do really say MV equals PY, and that's the bottom equation. The view that inflation comes from too much money chasing too few goods. Now, if you look in the footnotes of Friedman, my middle equation is there. And the way it works, the standard analysis is this. Look, the Fed sets the quantity of money. That determines the price level. And then the right-hand side of my middle equation adjusts. For example, suppose that our friend Ben Bernanke decided to run a 50% deflation and cut the value of the dollar, double the value of the dollar. Well, that means that the middle equation no longer holds. So he just calls up his friend Tim Geithner and says, hey, buddy, I deflated. Now the value of government debt is double what it used to be. You got to go double taxes to pay this stuff off. That's the way the standard theory works. Well, maybe Tim says no, right? As you get the feeling, this idea that this valuation equation will just take care of itself, that certainly is not going to work in times of fiscal stress. And, for example, when the IMF now goes to a country that's having inflation problems, they don't go talk to the central bank. They go talk to the Treasury and say, we got to have a tax reform here, because they understand that in fiscal stress, there's nothing the central bank can do about inflation. So we have a new theory. And it is the question of our time, really. How does all of macroeconomics operate when deficits are a problem? And it changes everything, as in my example. So when fiscal problems are a force to inflation, how does inflation work? Lots of classic doctrines that you learned as an undergraduate turn out to be overturned. This seems like something small, but in fact has big effects. So here's an example. There's my equation. We have one equation tonight, by the way. Money and government debt divided by price level. That is the real value of government debt. That has to be the present value of future surpluses. Now, the Federal Reserve does not print money. All the Federal Reserve ever does is it takes in government debt and gives people money in exchange, or takes in money and gives people government debt in exchange. It doesn't just give you money. Well, if I increase money and decrease government debt, that has absolutely no effect on this equation. So when fiscal constraints are there, open market operations have no effect whatsoever. It's just like, suppose that the Fed were to take your red M&Ms and give you green M&Ms. Well, it would change the color on your plate, but it wouldn't affect your diet at all. That's what happened. That's too bad. Second, only government debt, government money matters here. It's the government's promises to pay. So the government doesn't have to worry about inside money, liquidity, all that stuff. In fact, all of the classic sins of monetary policy, being passive, providing liquidity, pegging interest rates, these are all supposed to be sins because they leave the split between money and government debt indeterminate. But that doesn't matter anymore. So in fact, we can understand episodes where central banks are doing all sorts of naughty things. And most important for our policy thinking, deficits and inflation. The standard view of things is that, deficits, debt, Well, when the deficits get out of control, that's in the future still. When the deficits get out of control, then the Fed might start monetizing them. Then you might get too much money. Then you might get too much inflation. Well, that's not the way a valuation equation works. When people find out today that the stock won't be paying dividends 10 years from now, that goes today. And that's the same way that deficits and inflation work here. The minute investors find out that there's going to be untractable deficits in the future, boom, you get inflation today. So you don't get the time to wait. Well, that's your theory lesson. Let's go to applications. And there's two I want to talk about, deflation and inflation. So I thought this graph is to have something colorful other than text up there. And it's a way of reminding us of recent history. What have we had? We had the world as it was. We had a financial crisis when these are BAA and AAA corporate rates. These are the government rates. Government rates went down. Corporate rates went up. That's a financial crisis. Spreads went crazy. And in this period, obviously, the Fed was very worried about deflation and stimulating the economy. Then in 2009, we had the recovery. Long-term rates started going up again, and all of a sudden people say, maybe this is the sign of inflation coming back. But then Greece hit, and ever since Greece, interest rates have been going down, and once again, all the newspaper is about, are we going to have deflation or not? You can see that here's another graph. This is the 10-year Treasury. The black is the inflation protected. So that's the real rate. That's the nominal rate. This is actual inflation. And the difference between them is expected inflation. So you can see the pattern in the financial crisis, depending on what you take of TIP's meaning, there's no expected inflation left. Then expected inflation, look at that. TIPs go down, nominals go up. Everyone starts worrying about inflation. Now the treasuries are coming back again. It's tightening, so expected inflation looks lower. So those are the issues on people's minds, and let's talk about inflation and deflation and where it's going to go. Again, I have one equation. I'm kind of like a 2-year-old with a hammer to which everything looks like a nail. That is my hammer, at least for tonight. So, deflation. How do we understand deflation to start with? Well, there's our basic equation. So something's got to be changing. Something is pushing the price level down. It's certainly not good news about future deficits. So it's got to be the discounted part. And we are in the financial crisis. People were willing to hold government debt despite very low rates of return. There's a flight to quality, and now there's a flight to dollar after Greece. So if people are willing to hold government debt despite low rates of return, that means a low discount rate. And a low discount rate means a high value. A high value in a high value of government debt, that's low aggregate demand. That's people want government debt. They want to get rid of everything else to get more government debt. That's a deflationary force. Well, so at least we can understand something of what's going on. Now what tools does the Fed have to fight this? Interest rates, that's the standard one, but interest rates are already zero. Boom, that one's gone. Quantitative easing is on the agenda. Maybe the Fed, even though interest rates are zero, the Fed can buy lots more stuff. It won't affect the prices anymore, but it can take in Treasury debt and give you more money. But that's hopeless. Look at our equation. Taking in Treasury debt and giving you more money does nothing whatsoever, especially when interest rates are zero. This is red and green M&Ms, so that's gone. Well, on to quantitative easing, too. This is what they're talking about now. Let's buy long-term debt rather than short-term debt. Maybe that can help. Well, this can work, actually, even within our equation. Really, you need another equation for me to explain exactly how it works. Because my equation here is the simple version with only short-term debt. With long-term debt outstanding, if the Fed buys some of it back, then we have less debt coming due in the future and more debt coming due now. Well, that means more inflation now, but less inflation in the future. So the Fed can move inflation through time, and buying long-term bonds would do a little bit of that. Now, again, that runs out of steam, too, at some point, because you're just trading inflation. If you're in a deflation, everything's deflating, and just having it sooner or later doesn't help too much. And really, come on, let's face it, guys, is the central problem of our economy right now that, as viewed by the Fed, those morons at the Treasury just sold too much long-term debt and not enough short-term debt. There's maturity structure's wrong. We got to undo this. That's not what's wrong with our economy. And it goes dramatically the wrong way in the big picture. Long-term debt is a wonderful thing. Long-term debt changes the picture here because now if people don't believe in the government will pay it back, rather than having to have inflation, what can happen is interest rates can go up, so the value of government debt falls by itself without the value of government debt falling because we inflate it away. So long-term debt acts as a cushion and means that we can suffer bad news, bad fiscal news, without having what Greece had, financial crisis of rolling over short-term debt, and inflation is what they would have had if they had their own currency, but fortunately they don't. Well, so that's out. What can we do now? Well, quantitative easing 3, perhaps they could buy private debt, go back to buying mortgages, and that's what they did. Here's what the Fed did in the Great Recession. You can see when the financial crisis hit, they lent money like crazy, and most of it went right into bank reserves. But they also started buying mortgage-backed securities. The rise here is when they started buying treasuries. So they have been doing this quantitative easing, and now on the agenda is, should we do it again? Whoops, I don't want you to see that one yet because that's a joke. But now you know the punchline, which is too bad. So what happens there? Well, that doesn't make any difference, really. In the end, that means we issue more government debt, but the government has this private debt, which is going to pay dividends, so that means it has something to pay the government debt back with. So in the end, it stops working. So the Fed is now, when you read the newspaper, they're down to making announcements. Their big hope is that if they say, we'll keep short rates low for an extended period, that'll do the trick. And a lot of Fed governors are talking about that what we should do is make an announcement that the inflation target is going to be higher. Now, Teddy Roosevelt said that what one should do is speak softly and carry a big stick. This policy is speaking loudly and carrying no stick because we just ran out of actions. What can the Fed do about it if inflation doesn't come out to what it wants? The policy, let's just tell them we want more or less inflation, and it will happen. That was tried in the Ford administration. This is those of you who are young, this is whip inflation now, where they said, no, inflation this time they wanted to come down. We'll just announce lower inflation, and it will happen. So the Fed can get out of steam, unfortunately. I mean, that's the analysis here says that The Fed just doesn't have the central tool it needs to stop a deflation. Now, you may say, wait a minute, there was one more bullet point here. Where did my one more bullet point go? This is the problem of too many beautiful slides. Wait a minute. You can always have inflation. Just drop money from helicopters, right? Milton Friedman taught us that gives you inflation. Dropping money from helicopters is a fiscal, not a monetary operation. It's a transfer payment. And the Fed is not allowed to do that. The Fed always has to take something in when it gives something out. Now, and even dropping money from helicopters wouldn't work. Suppose that the government said, suppose the government said, we drop money from helicopters, but by the way, taxes are going up tomorrow, and we're going to take all that money back in taxes. Well, you just sit on the money and give it back to the government the next day, right? That's a case of more money on the left, but also we're going to raise some taxes on the right. Dropping money from helicopters is a fiscal operation, and it's really a psychological operation. It was brilliant of Friedman to invoke it, because when they drop money from helicopters, what you learn is this is money we really are going to leave out there. It's a fiscal operation that we won't undo. There's no exit strategy. But we don't have that. So even helicopters won't work. So in sum, deflation can happen, and the Fed is ultimately powerless to do anything about it, and for good reasons. If the Federal Reserve were allowed to write people checks, can you imagine what a political nightmare that would be? We couldn't have an independent Federal Reserve if it had the power to simply write people checks, because then, of course, the question, who gets them, would come up, and typically it would be a month before an election. Well, on that cheery note, let's move on to thinking about inflation, because having put up this link between deficits and inflation and so forth, you might be saying, John, are you out of your mind? The worry isn't that deflation will pass. That's a temporary thing, but we've got huge debt problems, and here's some graphs to show you. I mean, I said long-run surpluses, so here's a graph of the CBO's projection of what's going to happen to U.S. government debt. If you remember from your time at Chicago, e to the RT, now you know what that function looks like again. There's a label for that. The administration itself calls that unsustainable. And who am I to disagree? We talked about primary surpluses. Here's a graph of the actual, these are the net of interest surpluses, the thing that counts. And this actually is sometimes positive. In the 90s, for example, there was a big primary surplus. And no surprise, inflation was always good news. The technical term for what's happened to the primary surplus in the last year or two is a cliff. Not cliff as in a physical cliff. So it would seem that once we have right now, what seems to be going on is the discounted part is keeping aggregate demand up. People are flying to quality, willing to hold government debt for a little while because they know the U.S. government can't explicitly default. Eventually, that passes, and perhaps eventually markets get worried. Now, why hasn't it happened yet? I think people see this is mostly Social Security and Medicare. And we've known these have been problems for 10 years, 20 years. And I think sensible people, they understand these are problems that we could solve in 20 minutes as a matter of economics. They're just hard politically. But surely the people in charge of the greatest country on earth are not going to blow it up over things that we can solve in 20 minutes. And I think the markets have a point, so that's why we haven't had inflation yet. Sorry, I promised you one equation, but this one's so good I can't resist it. So we have, the longer run, as once the flight to quality ends, I think we should worry about this. What's going to happen? We have these unsustainable deficits, and there's lots of things that make it worse. So there's not just the on-the-books deficits. There are credit guarantees. The government essentially has guaranteed every mortgage in the country. States have discovered that by making promises to their employees, they can effectively borrow, even though it's not called debt. We've got looming state and local bailouts. The European Central Bank is now going to bail out every country. That makes matters a whole lot worse, in one sense. Here, what does all that do? A lot of these things are nominal choices. So if this surpluses here being just real is a little bit untrue, if we get inflation, the government's budget picture is much, much better. And that's actually good news because there isn't enough debt here. We could not fund, even if we just repudiated the entire U.S. government debt, well, that's not enough money to fund Social Security. So what inflation does is it means that the promises like defined benefit pension plans are worth a lot less. So what do we get? The bottom line is there's much more temptation for the government to inflate. If we could just double the price of every house with a doubling of inflation, that makes all those credit guarantees much easier to make. So the temptation to inflate is a lot bigger. The amount of inflation isn't as much as a result. The biggest danger is the equation so good that it had to be presented even on a Thursday night in the rain. What counts is the present value of future surpluses. So a simple present value model says that's the tax rate times income divided by the interest rate minus the growth rate of the economy. And the crucial thing that matters is growth. Now, why don't we just solve our budget problems with higher taxes? I'm intellectually honest. If that's the solution, I will say that's the solution. But here's the problem. Tax revenue is tax rate times income. So if we increase tax rates, that doesn't give us the full revenue because income declines. If you increase tax rates, people decide that they want to take vacations. Worse, high wealth people decide that they want to leave the country. Raising tax rates lowers income. That's the Laffer effect, which is the second term here. For those of you who can still take a derivative, which I don't pretend you should. There's three terms. If we increase taxes, what do? We get $1, but then that's decreased by the fact that income goes down because people don't work so hard. That effect, I tend to think it's bigger than most, but many people think it's not. So here's an example. If we raise the tax rate from 30 to 35%, it would take a 15% reduction in income before we're not making any money. We can argue. But here's the killer. Suppose that if raising tax rates lowers growth, then we're dead. Because what counts is these surpluses out into the long, long future, and the way you make money in the long, long future is not with high tax rates, it's by letting the economy grow. So quantitatively, I worked out this term. If raising taxes from 30 to 35% results in 0.3 of a percentage point less growth rate, we're toast. And toast means that rise in taxes generates no extra revenue in the long run. It generates nothing to help you against inflation. So that's the real danger. I don't know of any country that paid off a huge debt by raising tax rates. The way you pay off a huge debt, the way we paid off World War II, was by growing like crazy. And the danger zone that we're going to, when this falls apart and we get inflation, as I read the equations, so I'm just guided by the equations here, the danger zone is that we wake up and say, this economy is into a long period of low growth. High tax rates, high distortions, whatever, low growth. If markets decide we're low growth, the present value here goes down and we're in real trouble. So I tried to get a scenario, how would things look if they became really bad? So here's a scenario. Now, so this is a very simple idea. Suppose that at this date right here, bing, there's a shock, and markets wake up and write down the value of the U.S. government by 10%. So that's the question. What happens? Well, we don't get 10% inflation right away because there's this wonderful stabilizing effect of long-term debt. We have some long-term debt. It can take up the shock. And there's some debt management can do it. So I drew a scenario here where the government can delay this inflation by 4 years, until 2012. There's some variety in what the government can do in response to the surplus shock. Wait till the next election seemed like a reasonable guess of what our government would do if faced with an inflationary shock. And so you can do different things. It depends on the amount of long-term debt you have outstanding. But what's the scenario? Shock comes today. We don't see inflation today. What we see is a mysterious rise in the long end of the yield curve, as we were starting to observe in 2009. Then gradually other interest rates come up, and then only slowly do we see inflation. So that's what sort of the equations point to you as a scenario. Don't look for bing inflation all of a sudden. Look for this mysterious rise in long-term rates, which of course the politicians will say, oh, there's speculators, the markets, evil Wall Street, the animal spirits. No, they just know what's coming. Inflation's coming, you're going to send long-term rates up. Now, some people seem to think that inflation might be a good thing, too, so I ran this scenario through sort of a standard it's called the new Keynesian model, standard model, which Just what the point of the standard model is to get an idea of do we get a boom or a bust out of here. So here's the inflation. The inflation's delayed like that. Here's the path of interest rates. Now, interest rates go up ahead of inflation because that's what interest rates do. So, the Fed would say inflation's breaking out. The Fed would say, no, but we've been good boys and girls. We've raised interest rates with inflation. We're being tough, and it's breaking out. We don't know what to do. In the meantime, output's going down because this is expected inflation, and expected inflation sends output down. So the picture I see is if this happens, and this is an if, it's not a forecast, what we get is stagflation. That's cheery. Well, how about the Fed? Is the Fed worried about either of these things? Here's the latest FOMC statement. It says, measures of underlying inflation have trended lower, and with substantial resource slack restraining cost pressures and longer-term expectations, inflation is likely to be subdued for some time, so don't worry. Now, the reason there's so much disagreement about inflation and deflation is because different people have different theories, different causal mechanisms in mind. So when you read a statement like this, there isn't one agreed upon theory. As I kind of put together what I think the Fed thinks, the way they think about inflation is they set interest rates, that affects demand, that affects slack and gaps, and then slack and gaps lead to inflation. It's a fairly unreconstructed 1976 Keynesian view of the world. And to the extent they worry about deficits at all, and Bernanke is doing a wonderful job of starting to speak up against deficits, it's not my mechanism. It's something about in the long run crowding out might be a problem, but not yet. They've simply forgotten the fiscal backing. Now, how does this theory work out? Let's look at the history of gaps. Should we not worry about inflation because we have big unemployment right now? Well, let's go look at how inflation and unemployment evolved in the past. So here's the last 10 years of unemployment on the x-axis and inflation on the y-axis. And the Fed's view of the world is that there's a negatively sloping line here. So that if unemployment is low, then there's danger of inflation. But if unemployment is high, don't worry about it. We won't get inflation. Now, in the recent period, we've got kind of like a flat line. There's not much relationship at all. But really, the longer history here was kind of like going up and down. And if you remember back to the 70s, when those of us who were alive at the time had unfortunate haircuts and even worse suits, here's the history of inflation and unemployment in the 70s. It kind of like looped up like this. So let me remind you of anno horribilis, as the Queen might say, not 1970. I'm too old, I can't read it. Is that 73? 73, but what that time was considered bad unemployment, yet inflation shot up anyway. 76, 77, 78, unemployment at unheard of 7%, inflation shoots up anyway. There's nothing like a stable leftward line in here. So the fact of high unemployment, I don't think should make you feel all that great. This has been so far a unpleasant talk. We could have deflation, we could have inflation. There's not much the Fed can do about either because fundamentally they're set by fiscal arrangements. Is there anything we could do? There is, but I think we are at the moment where our current arrangements don't work, and it's time to think outside the box a little bit and think how else could we run our monetary policies? What new tools are there? So this is what I'm working on right now, and my thoughts are running to a modern version of a commodity standard. In the days of a gold standard, this wouldn't be a problem. You should say gold is $100 an ounce, bingo. That nails the price level. You don't have to worry about inflation, deflation, or whatever. And it is a fiscal commitment because you need to tax people to have the gold in order to redeem the dollars. So it solves the problem. Now, we can't have a gold standard in the U.S. because gold and the consumer price index just go completely haywire. If gold can go up to 1,500, leaving the CPI behind, well, the CPI can deflate while gold does nothing. So what we need to do is one possibility on my mind is to think of an arrangement that works the same way but would work for a modern economy. And what I'm playing with now is the idea of targeting CPI futures or the Treasury inflation-protected spread. It works the same way. That targets exactly the thing the Fed is interested in. And if you get deflation, then the Fed, in having targeted these things, will be just pumping money out into the economy the same way they would do under a gold standard. That's one kind of thing we're thinking about. And another thing to think about is much more long-term debt. Long-term debt is a great thing because it's a cushion, and if the government moved to more long-term debt, then we wouldn't be in this situation of all this fuzzy stuff I've been talking about, that maybe we'll get inflation if investors think that surpluses are bad 20 years from now. Maybe we'll get deflation, crises could come. Couldn't we nail this thing down a little better? Well, some sort of standard would do that, and more long-term debt would mean that the shocks to this stuff would show up in interest rates and the value of long-term government debt and not so much the price level. Everyone wants banks to hold more equity. Long-term debt's kind of like equity, and so the government ought to hold more equity as well. There's lots of other kind of ideas that I think flow from this, and I think this is the moment. Once you recognize what we've got is likely to get unhinged one way or another, sooner or later we'll be thinking about better things. Now you may say, oh my gosh, now another crazy academic talk. I'm sure you've heard many of my colleagues with their loony theories. But let me remind you, quantitative easing and the alphabet soup of new things that the Fed has done in the last 2 years, many of them quite useful, those seem like crazy ideas. We will someday, and probably soon, fundamentally change our monetary affairs. We had a gold standard that led to Bretton Woods, then fiat money, then exchange rate pegs that fell apart in the 50s, then monetary targets, now sort of this Taylor rule thing. The Taylor rule thing's kind of falling apart and into quantitative easing. The euro's going to get rethought. Today's crazy idea is tomorrow's obvious thing. So that's the fundamentals of how I'm thinking about my deep research on the price level and how it illuminates where we are and where we might go. If you're interested in more, let me admit I'm here to serve my university, but also for blatant self-promotion. The ideas I've talked about go under the rubric of the fiscal theory of the price level. Here's a short list of things I've written about these things. All of it is on my webpage, which has all sorts of interesting stuff, like if you thought gliding was interesting, that's on there too. So thank you for listening, and why don't I take some questions? Yes, please.
What is the research shown on tax rates and growth rates?
Tax rates and growth rates. What is the research shown on tax rates and growth rates? I want to say that low taxes are good, but I'm...
But what does the data show? Can you separate population growth from it?
Well, okay, so what we want to talk about is growth in per capita income, not just growth in countries overall. And so, the general consensus is that low tax rates, but especially stable tax rates, property rates, not a country that spends its whole time on loopholes, even if the tax rates are low, isn't a very good one. You need stable, clear tax rates, and can I think of a study that says what is so obviously true? Now I get to lose my academic reserve, so I'm going to have to. That's what I think the answer is, but I can't quote 5 papers off the top of my head. Next, please.
Yeah, just kind of a follow-up on that. Like you mentioned that you thought that raising taxes right now would probably be a bad idea. But if we let the Bush tax cuts expire and we go back to the rates that we had in the 90s when actually the economy seemed strong and we had a surplus, right? I mean, why would that be so bad?
Here's the current tax rates, and here's the estate tax, and I think the estate tax is particularly bad. Grandma better watch out December 31st if they don't do something about that. Do you know about incentives? Income tax. So 30 35 versus 39, it probably isn't the end of the world. In our tax system, I worry much. The huge distortions are not the statutory rate, because basically what happens if you make rich people pay more money, they just hire more lawyers. So that the amount of taxes actually paid by rich people is remarkably independent of the statutory tax rate. If you're a lawyer, I guess you like it, or a tax accountant. I don't think we're going to actually get much more money out of them one way or the other. The horror in our tax code is the 50,000 pages and the loopholes and all the rest of the chaotic mess that we've got in there. Next, yes.
Why wouldn't it be better if the Fed buys private debt from banks that might be, in reality, marked somewhere down at a heavy discount and replaces it with claims on the government itself? Why doesn't that, trigger growth, ease credit? Why doesn't that mechanism work? I mean, banks, it solves the bank's problems, and investors in banks and so forth's problems in a heartbeat.
Well, what you're advocating is what the Fed is really not supposed to do, which is to print up money and give it to people, in this case, banks. Because you're advocating give the money but take back assets at a higher value than those assets are really worth. The Fed has been careful not to do that. It makes the truth. So the Fed is running the world's biggest hedge fund right now, and I mean that seriously. They're borrowing, short term and investing in illiquid, toxic stuff, and they've done it in a special. They put together special purpose vehicles where the Treasury has the equity tranche, so that the Fed can say it's only risky. It's not all kinds anymore. You're supposed to take safe stuff to the discount window. So that is a mechanism for printing up money and handing it out. Now, the problem is even printing up money and handing it out doesn't necessarily do any good if everybody thinks there's an exit strategy, and so they can just sit on that money rather than trying to spend it. So it doesn't obviously cause inflation. And I'm just so... The idea of bailing out, unsuccessful banks sticks in my throat so much that I'm having trouble being more coherent than that. Yes, please.
Your comment didn't deal with the course of the currency. Since the U.S. has a reserve currency, does relative change in prices of currency to other countries, currencies have a serious effect on the behavior of your equations?
Yes, and actually, they didn't deal with a lot of things. I was trying to, vaguely keep the nice lady in the back of the room from waving the flag and saying, shut up, shut up, shut up. So the same idea holds for currencies. When does a currency collapse? When people understand that the government is, that the government has, I lost my one equation. When people understand that the government isn't doing well. Similarly, I went through my litany of the things you might do to try to stop deflation. And intervening in currency markets is one way to try to devalue the dollar against other currencies as a way of trying to get some inflation going. It has one defect of that policy is that, of course, as gold is kind of separate from our price level, price levels in Europe are kind of separate. These, they can kind of wander away from each other for a long time. The deeper problem is that our trading partners don't want to sit still for it. Because everybody wants to devalue their currency relative to somebody else. So they have to, in order for that to work, you have to have everybody else sit still and say, okay, yeah, you can devalue the dollar relative to us, and we'll just suffer the consequences. Well, no, they're trying to devalue relative to you, and next thing you know, everybody's the race to the bottom. Yes.
You said that you'll see long-term rates rising before we see pickup in inflation. So, what are some of the other signs that you might look for before you see these are some of the early signs that we'll see higher inflation?
Okay, I'm glad you asked that because I want to back off that quickly. That was kind of a simulation of how, what would happen, I think, is we would see if there's a fiscal crisis in the U.S., what we're going to see is kind of trouble in financial markets first, and then we'll see inflation gradually appear. I kind of wanted to get away from the idea that we would see bingo inflation right away. Now, long-term rates, people look at them as indicators of inflation, and I did too. But actually, historically, long-term rates have been terrible indicators of inflation. There's a lot of risk premium in long-term rates. I think I brought along a slide for every question anyone could answer. And I think I have the long-term rate slide here, if you just hang on. Here, long-term, see? I knew you were coming. Historically, here's the red is the long-term rate, and the blue is inflation. And long-term rates were just doing a terrible job. Here's the long-term, this is the 10-year rate in 1975 or 76, and that 10-year rate is doing nothing to tell you that inflation in the next 10 years is going to be higher. That's what you're supposed to see in this graph. Is this date's interest rate corresponding with that date's inflation? Absolutely not. And on the way down, interest rates here didn't see the decline in inflation either. Another way to do the same thing, I told you I got graphs for everything, here's long-term, here's the 10-year yield, and there's the inflation rate. Do you see any positive correlation? So long-term rates are contaminated with all sorts of other stuff. So I do think we'll see, if this happens, what we would see is turmoil in the credit markets only followed by inflation. And we would see a lot, because the credit markets are looking ahead and our politicians say, oh, I don't know what's going on, our models don't work anymore. But it's not anything so simple as just watch long-term rates and then you'll know when inflation's coming. Yeah?
To what extent, if we took steps to eliminate trade deficits for the U.S., can we solve all of these problems?
I am a complete skeptic on the notion that global imbalances are a problem that need to be addressed, and that some wise collection of ministers at the IMF can diagnose, should we be importing 100 billion this year or 200 billion this year. I think international trade's a great thing. And let me put it this way, so back to theory in a sense. For 20 years, most of what international economics did, well, I got to watch myself. Bob Hodrick, a very famous international economist, is sitting in the back. Okay, Bob. Half of what they did was puzzle over the fact that trade balances were too small, that countries who wanted to invest would do their own saving rather than borrow from somebody else. Well, then in the 90s, the world started to look like our models, and current countries like, say, Japan, which had a population that really wanted to save, would be sending stuff abroad to somebody else who really wanted to invest, and China's doing the same thing. A lot of what's going on in China is they have a demographic bulge. Those people want to save, so they send stuff abroad. So the world started looking like our models, and then we said, oh, imbalance. So it's a longer answer and probably not the question you had in mind, but I'll go on to another one anyway. Yes, please.
Your equation, given that debt has skyrocketed and price levels haven't moved, it implies that market expectation of future surpluses has skyrocketed. And I think you're saying that the market will soon be proven wrong. And
no, I would never disagree with the market, but sorry, go ahead, yes.
And so I guess you're predicting that inflation must eventually skyrocket, but isn't that
I'm not predicting anything either, so get that on tape.
Isn't that actually what the Fed wants, is inflation? Isn't that the whole goal of what they're doing?
Yeah, the Fed seems to want inflation, which is kind of interesting. They want expected inflation, which everybody's theory says causes stagflation, not actual inflation. And they're working hard on how to do it. So my job is to take this, which works beautifully in theory, and try to understand the world with it. And I think you're right. I mean, that certainly is embarrassment number one for me is I look at our budget situation, and it looks catastrophic. So I say, okay, why aren't we having huge inflation now? Well, now I got to start going blah, 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 or no, sorry, let me put that technically. I have to invoke other causes. So certainly one thing that's going on is I think, those projections are projections under current law. And come on, are they really going to let that? It's not hard. For the U.S. to solve its fiscal problem is not economically a difficult question. Federal government debt, our spending to GDP is 25%. And that's not a hard problem. So one theory is that markets still think, okay, it's the middle of a recession. They're going to get it together, and they'll get their act together, and they'll solve the future surpluses, as they say they're going to. It's kind of the what's coming out of Washington is the St. Augustine prescription. Give me chastity, but not quite yet. They're saying that if you really want to inflate, you need the Casanova prescription. You need to have, never give me chastity, and then we inflate. But markets are probably thinking that they're going to solve this problem. And the other part is the discounted. Now, in my other hat as an asset pricing person, what we've learned in the last 10 years, if you want to understand stock prices, you do not understand variation in stock prices by variation in expected future cash flows. There's just way too much variation in stock prices to account for the future cash flows. Instead, low prices correspond to high subsequent returns, high risk premiums, high discount rates. And I think that's what's going on also in debt markets. There's a flight to quality. People are willing... Investors look at the U.S. government debt and say, we want that stuff. Not because we think 20 years from now it's going to be a great deal and they're going to pay it all off, but we think we can be in there for the next 2 or 3 years, and then we can get out, it'll get rolled over, and we don't have to face this problem. So that's the discounted part. So that's my stories, at least, on why we could have this looming budget problem, but it has not yet shown up in inflation. Yes, in back.
This will be the last question.
Oh, okay. Yes. Everyone.
Does it matter who holds the debt?
Yes. Oh, good. I have sort of a couple speeches. That gives me a chance to give another one of my canned speeches. Well, it matters to the U.S. So the Chinese are holding a lot of our debt. And if we inflate, they get screwed. In fact, we did it once already. We sold them a whole bunch of debt when the dollar was at 0.9 euros. And then the dollar went down to about 1.4, 1.5 euros. So the Chinese, who had invested trillions of dollars with us, could now buy half as many BMWs with them as when they bought it. And what did they do when we did that to them? They turned around and gave us more money. I mean, how many of you run hedge funds and have customers who you can report a 50% real loss, and they turn around and send you billions of more dollars and put cheap stuff on boats and send that to you, too? I mean, the proper policy response to China is flowers and chocolates. So it does matter if we inflate or if we devalue. Right now, that means it's going to the rest of the world. We are unique in that we get to borrow in our own currency, and foreigners are willing to buy that. That's part of this. Somebody asked about reserve currency, and I seem to not have gotten around to that question. That's the advantage of having been there. Not the reserve currency, but the reserve debt. Central banks around the world hold U.S. government debt. They don't hold currency. And so you get a one-time, you get to have a whole bunch of boats full of stuff going to your shores because you sent them paper that they seem to like to hold. Well, if you devalue, that whole game's over, and then we're going to have to put stuff on boats and send it over there, or we're going to default on it, which would be unpleasant. So it matters. Okay, one more.
Can you apply your model to the case of Japan, where they have high tax rate and low growth rate, yet they're not getting the inflation. They're not even getting the asset inflation, except the JGBs.
Yes, you guys got to ask all the hard questions, especially last, right? So why does Japan not have inflation? Now, many countries that have faced fiscal problems, like, say, Greece, go year after year with sort of Cassandras saying, oh, look at the debt, it's unsustainable, and everything, don't worry about it, boom, and then boom, it goes. So kind of one insight that the analogy with stocks is that, like stocks, it can last a long time and then go boom, and that's exactly what we might expect. So I'm here giving the not yet answer to Japan. Now, another answer to Japan is that most of its debt is domestically held. So Japan has a demographic bulge, and a lot of people want to save for retirement, and it's very hard for them to do anything but buy Japanese government bonds. So that could explain why we are keeping this demand for Japanese government bonds in the face of a lot of debt and not really clear pictures of how they're going to pay it off. Of course, these people are all about to retire, and they're all about to sell their Japanese government bonds, and I'd like to know to whom. So that may be the event that starts getting Japan in trouble. And Greg Menkiew's blog had a lovely indication of Japan's looming problems, which is he included a video, an advertisement from the Japanese Ministry of Finance. There's this very beautiful woman, and she says, "I like men who buy government bonds." So when you're reduced to this, is a sign that the answer to your question may be, not yet. Because it works, I don't like to use the word bubble, but it works the same way. People are saying, well, houses are overvalued. Well, yeah, but, nobody paid any attention to them for years. So, government jet could be the next bubble in big quotes. With that, we have to leave everybody who wants to leave a chance. Thank you very much for coming out. I hope you enjoyed it.